Welcome to the Prescient in Perspective webinar, where we will be discussing the first 6 months of the year and then our forecast for the next 6 months of the year. I'm Joanne Bainham from Asset TV, and I'm joined by Bastian, Henk, Conway, Rupert, Vishal, and Romelin. So please stay tuned. I can promise you a very exciting next hour. Bastian, I'm going to kick off with you. The first 6 months this year has been very busy. What's kind of driven those returns? What have we seen?
Yeah, thanks, Joe, for coming around, and thanks everyone for joining. I guess I will go even further, look at the last 12 months. And what we've seen is, I guess, a slowdown in global growth, slowdown in GDP growth, mostly driven by the States. So we started, if I just look June last year, we were growing above 3%. September last year, we were growing above 3% in the States. And then if we look at December last, we slowed down to just above 2%. And then March this year, we actually negative. We printed negative 50 bips annualized, seasonally adjusted in the States. So that means there's been a quite remarkable growth slowdown. And we do think it's driven by the policies and the uncertainty from the Trump presidency. So when Trump took office, there was a lot of positivity, a lot of excitement about structural reforms around business deals in a positive way. But what we've seen after that was actually the opposite. A lot of talk about trade wars, and that obviously detracted from business confidence and with that from economic growth. More good news on the inflation front. We got that one right, I will say, that from the beginning of the year until today, inflation was on a downward trajectory. Yes, we had two slightly stronger prints on inflation again, but if we look at just where we were at the end of the last year, beginning of this year compared to now, CPI is a little bit lower. Core PCE is also lower. PPI, which is forward-looking, continues its downward trajectory. So we've got less growth, but also less inflation. And what drives capital markets most? We think monetary policy is a quite important driver here. So what did the Fed do? Not just actually what they did do, but what is the pricing of the Fed? And if we take the look out a little bit further, all the way into the end of next year, we can see now that there's 4 cuts more priced than they were priced at the end of last year. So basically kind of like a more dovish stance, and all of that helped us to drive equities higher globally and locally. Bond returns were stronger, and currencies compared to the dollar also appreciated. So good news for capital markets all around. I guess a big question which we have to answer today is where to from here.
Okay, there's a lot that you've unpacked there, and I think the question is what going forward, but we'll get there. Henk, we talked about interest rates being priced in 4 cuts for the next 12 months. Inflation's coming down. What do you see on interest rates, and particularly around your fund the last 12 months? How's that impacted returns?
Thanks everyone for joining us, and Joanne, thanks for the question. Yeah, it's been an interesting 6 months. Arguably, rates have remained higher than potentially expected. But for us, earning those rates at the front end of the yield curve is obviously fantastic, right? So we think about the real returns we've seen, specifically in the SA context, exceptionally high. Inflation still sub 3 for South Africa. Yields, if you look at JIBOR, north of 7. So very risk-free CPI plus returns, that's been exceptional. If we think back to the volatility we have seen, and think specifically around income provider and our risk hat that we put on, not to try and lose money over any 3-month period, we've done exceptionally well to get to our return where we are just around 6% for the year without breaching that target. When you think back to April, Liberation Day, Rand went to north of 19, bond yields sold off, etc., etc. Even in those periods, we saw very steady and very accretive yield profiles in the portfolio. It's exactly what we're trying to achieve, right? To get to our CPI plus target within that risk framework. And having these elevated front-end rates makes that a little bit more easy. And we've talked about it a couple of times. We call it a sort of a Goldilocks period for the front end, where we get to achieve our targets without having to take excess risk.
Vishal, fixed income. No one thinks of it as a sexy asset class, but my gosh, the returns have been great this year. Tell us more about the first 6 months.
Indeed, the first half of the year has been quite a positive one for bonds. We've seen a good return from bonds. I think in terms of key drivers, maybe start off by answering the question as to what we do not think has been the key drivers. So firstly, financial conditions have not eased relevant to South African bonds. The Euro and the BOE have cut rates, but in the US they have not. The curve there has still not materially changed. The slope is still fairly steep. And if that was to have to materialize, then we'd have seen a rally in risk assets. Secondly, South Africa the real yield of around 1 to 2%. The economy is continually growing, but not amazing. What we think has been the key driver for this rally over the first half of the year has been the communication from that of the SARB. So they've communicated that nothing has come out yet, but they've sort of spoken about shifting target lower from 4.5% to 3%. Now, being a systematic house, we like to quantify things. And one of the things that we do is that we decompose the 10-year real yield into its various components. And the two components in particular, the inflation risk premium and the average expected inflation, they both come down. So the inflation risk premium has come down by between 50 to 60 points, and the basis points, should I say. And then the average inflation expectation has come down about 30%. So that's about 90 basis points attributed towards the bond performance, which has been one of the reasons why we feel bonds have performed well in the first half of the year.
So if I put that in a nutshell, you're saying there's a lot of confidence in the SARB to do what they say they're going to do, and that's why we've seen expectations of inflation, expectations of interest rates falling.
Correct, right? So the one component, the inflation risk premium, that can be thought of as the market's confidence of that of the Reserve Bank, in this case the SARB, and as mentioned, that has come down between 50 to 60 basis points in the first half of the year.
Okay, we're getting to equities. Ramelan, another cracker of a year. I've used the word cracker twice now, but anyhow. Emerging market equities have been phenomenal. South Africa has been great. Even developed market equities are going up. So in the world that you play in, what have you seen?
Thanks, Joanne, and thanks to the viewers. As Bastian mentioned, and the other gentleman on my either side, capital markets have had a good year, and equities are no different. Before we contrast the different markets, I think it's very important to note that equity markets have had healthy performance across the board, across geographies, and that did not come without volatility. And it's not like the safer asset classes where you can have a very smooth accrual of returns. Equities does come with volatility, and this year was no different. We had the trade policy uncertainty with the US and China, increasing tensions with the tariffs. We had the war in the Middle East, which affected oil prices, and that can translate into high inflation and then affect investor sentiment. There's also moderating growth concerns in major economies like China, the US, and Europe, which can also affect investor sentiment. And lastly, and I think this is a spotlight, Henk also mentioned like the monetary policy, and we saw that the Fed is a bit more cautious. And all of these things resulted in volatility in the market. And we saw big swings on Liberation Day when those tariffs were announced. Some equity markets moved 5%. Developed markets started the year a bit slower. I think it was developed markets are mainly made up of the US, and then valuations were quite unattractive. Our view on US equities at the beginning of the year was moderately negative because of the low dividend yields and high P ratios relative to the long-term medians. And the MSCI World delivered 9% for the year, but that was because of recovery in June for the year so far. Emerging markets far better. I think investors thought that valuations were far more attractive than the overpriced tech companies in the US, and the MSCI Emerging Market Index returned 15% for the year, which is about 6% better than developed markets. And then bringing it to South Africa, South Africa has had the equity markets up 17% for the year. And
17%, that's a big number.
That is a very big number. That's following on from the strong performance last year. We've seen all-time highs, and despite the local uncertainties with the GNU instability and the budget and potential fiscal policy issues, we've seen that monetary policy has remained quite transparent, and the equity market has performed really well. The sectors that we can talk about is space materials, up over 40%, largely driven by gold shares. We saw that it's a very interesting time in the capital markets where there's volatility, and there's usually a race to the dollar when there's volatility. But because of uncertainties in the US, we've seen our gold shares really benefit from that. The telecommunications sector surprisingly up almost 50% for the year, and that was just on strong fundamentals improving in those companies. And then lastly, technology through Naspers and Process via their holding in Tencent, which has really recovered this year, we've seen about 30% performance there. And summarizing all of this, the South African market has been really strong because there's been a bit more risk taking and valuations have been really attractive. And that's how we've seen that impressive return so far.
And particularly in the SA equity markets, have we seen a foreign participation increase, or is it mostly locally driven?
It's mostly locally driven. We have seen net foreign outflows, so yeah, mostly locally driven.
Okay, Conway, it's your turn. Corporate bond markets, they've been fairly liquid for a long time. Is that still the case in the first half of this year? Are we still seeing such tight spreads? Tell us more.
So, good morning, everyone. So I think the starting point is the credit or the debt capital markets is nothing new. So we continue to see a massive demand-supply imbalance, which affects spreads and affects everything that we do. What I mean by this imbalance, we've got a massive amount of flows into income and income-type funds, specifically in the multi-asset category. The first 3 months of the year, there's been about 7 billion rand of inflows. The last year, there's been about 18 billion. Yet the debt capital markets is contracting. There are no new issuances, no new real issuances, and then importantly, no real actual risk-taking by corporates. So there's been this de-gearing exercise that has happened. So you've got a lot of money chasing very few issuance, auctions or assets, which actually then creates that spread compression. And in a world where you have GNU, you have geopolitics, President Trump doing his thing, and people actually pausing on auctions and the likes, you can understand that as you chase those assets, the spreads generally come down, and it doesn't reflect economics. Basti and I actually had a proper conversation yesterday. It's probably time where spreads should start widening given all of what we're seeing macroeconomically, but that isn't the case. So in that instance, what do? We have to actually consider auctions a little bit more circumspect, because we do see an increase in default probabilities across various sectors. Yes, on average, the corporate sector is looking really, really good, and we're seeing great returns in the equity side, forward returns looking better than before. But on the credit side, we only have our coupon to protect. And again, when there's increased risk, our systematic approach then leads us to see how do we embed, or how do we think of risk a little bit differently? What type of opportunities do we look at differently? And then how do we still deploy capital? Because ultimately we have to invest. But again, it's been a continued theme of very little issuance and a lot of cash chasing very few assets.
And Conway, the fund you run has a credit underpin to it. Would you ever close that fund if you just found it was getting too difficult to find opportunities?
So I think that this is what our key selling point is. We have a team that goes out and originates opportunities, whether it's longer dated opportunities, unlisted opportunities, clean energy, renewables, or infrastructure. That is how
you'll have
we
to go and originate deals, and if they're not actually out there saying to companies, we can give you good finance.
Exactly. And I suppose in Heng's view, it's not easy, but I suppose that is what differentiates us. It allows us to do those type of deals that aren't out there in the market, whether it is smaller type opportunities to fill our basket and actually live our diversification principles that we actually embed across all of our funds, or actually just harvest that term premium of doing longer dated opportunities with credits that we actually know that are actually healthy.
Okay, so increasing durations of funds of credit so it's not about new credit, not new credit, it's just duration of existing credit.
Rolling existing exposures, instead of doing a 3-year deal, you do a 5-year deal, and then you get enhanced returns for taking on that additional risk. But it's again not an increased default probability risk, it's just changing the way you're doing it. And then also looking at opportunities like structured notes and the likes, which is very important for us. We have a team that builds these models and then considers all of it systematically.
Okay, Rupert, you haven't spoken yet. We've talked about various asset classes around the table. Is there anything else you'd like to add to this discussion?
Yeah, it's nice to have the last word in a way. I think it's important to take a step back again. So to go to Bastian's earlier point, if we look at the world and we look at that multi-asset class mix from a global perspective, where we allocate around South Africa, emerging markets, developed markets, we are an open book here. We don't have a bias towards any of them. And I think what's interesting this time around in the last 6 months versus the first time we had trade wars a couple of years ago in the first Trump era, this time around emerging markets have rallied around 20%. South Africa's rallied pretty much in line with other emerging markets, so no big disconnect between South Africa and other emerging markets, which is great this time around, so we're not seen as a separate type of scenario. But the US went through a saga or scenario where they were negative for quite a while and then have only just finished the first half positive. So when it comes to US policy, US growth currently downgrading towards the zero line. And when it comes to broad-based politics, I think the market's just not buying the trade wars this time around. And then a second interesting fact that I like to mention often is that if you look at China specifically and you look at the percentage of Chinese exports to the United States as a percentage of their entire export basket, it's 10%. And I think the market now realizes that if Trump has his rhetoric around shutting off, let's say, China and other big economies, China will just find another trade partner. So it's about a shift in global geopolitics. It's not about a shutdown in global geopolitics. And that's why we've had strong rallies across asset classes, in particular in South Africa and other emerging markets.
I'd love to debate with you the whole China 10% to the US story, because they've also increased their exports to Vietnam and to various other places, who then in turn export to America. Yeah. But I think that's why Trump was trying to put tariffs on everyone. Yeah. Because I think his first time around, he only sort of put it on China, didn't he?
Yeah.
And then China worked out the back door via Mexico or various regions.
Yeah. I think also another interesting change that we've seen in the first half has been a weakening dollar. And the key behind a weakening dollar is that your trade deficit actually shrinks. So it's if anything, it's a self-correcting policy where you're no longer having those massive trade deficits because it's now a much weaker dollar. So whether after all of this, whether we actually need those tariffs or America needs those tariffs is another question. Yeah.
Yeah, I think, as you say, I think defining the first half of the year has been incredible dollar weakness, which has gone into all other asset classes. Bastian, back to you. You know, we talk about trends in the markets, and when I look at the economic data that I see, there seems to be an awful lot of noise out there. Given your systematic trading processes, how do you differentiate between what is noise and what is signal? And perhaps just explain kind of things you're looking at the moment, relative things like consumer confidence, geopolitics. Tell me more.
Yeah, 100%. So we use what we call the Prescient economic indicator, which is our own in-house nowcasting. So what we basically do is we put together 150 different time series which update, well, some of them only update quarterly or monthly, but we update the data every day, so that if there's a new data print released, every single day we get a new estimate of US growth. And that has worked incredibly well for us over the last couple of years, having a quite accurate understanding in real time where US GDP is and where are we right now with that estimate. We're kind of like close to the zero line. So we've tracked the slowdown all the way down long before GDP was printed, so it has worked pretty well. And what we're tracking right now is again a quite compressed growth picture. No deep recession, but certainly no rally and certainly no strong upside. But what we do measure and what we can track is basically this quite pronounced slowdown, which I mentioned already earlier. How do we differentiate noise from facts? We do that systematically as well. So we have all of these 150 data series, but they all have a lot of history. So we go back through time and we can update and attribute exactly what's driving GDP right now. It's obviously different stuff driving it now than it drove it in the 60s or 70s or 80s, but we understand that exactly. So systematic way here is really the way to go, because it tells you what is noise and you don't have to guess what's noise, right? So
before you go there, so there's soft data and there's hard data. Yeah. And from what I'm reading, the soft data today is people's opinions and the hard data is facts. Maybe I'm wrong. But the soft data used to have a lot of people giving input into that soft data. Yeah. It's becoming less and less relevant, or am I talking rubbish? Is that something you're seeing?
No, you're not talking rubbish at all, and even if I wouldn't say it. So.
You can still say it. I'm not scared.
The reality is you're spot on, I guess. There is soft data, there's hard data. Hard data is what we really track the economy in. But the soft data has an important function to play. So the soft data is something exactly as you said. It's like sentiment, can be consumer confidence, business confidence, investor sentiment. To track that is not as easy because often it's just surveyed data. But we also create a lot of alternative data, for example, on the investment sentiment side to understand what markets are thinking. And the reason why soft data is important, even if it doesn't show up in the hard data immediately, it has actually a leading function. So normally the hard data follows the soft data, not the other way around, right? We pick that up in our economic forecasting and in our costing. We understand these relationships because we look into the past. The challenge has been for markets, and I think that's where this time is different, that the hard data doesn't seem to be following the soft data. So with that, you're 100% right that it looks like that there is a disconnect between the hard data and the soft data, and this time around the hard data is not following the soft data. So what do we make of it? Well, we understand that there's always an error term around our now costs, but we will not neglect the soft data, right? So if business confidence tanks long enough and if consumers keep on losing confidence, eventually the hard data will follow. And we do actually argue that some of that is already happening. For example, if you look into the labor market, there's ever more, we can still argue it's still quite strong, but forward-looking labor market metrics are showing quite a few cracks, right? So wage growth is stalling, there's less hires, there's less quits, and those weak metrics are probably a function of business being on standby, business not hiring, consumers not spending. So I do think this time around, the hard data will once again follow the soft data. Maybe the lag, for whichever reason, is bigger, but we can't ignore it entirely.
I think just to extend what Bastian was saying on the labor market, what's interesting is that a lot of people focus on headline news because that's what sells, right? So you'll see US unemployment still looking strong. But if you look at something like hours worked in the United States, it's been decreasing quite strongly. So that means that people are employed, but they're working less, which means productivity is potentially lower, right? So you've got to measure things across all the different lenses that are possible to you to create a proper all-in picture around global markets.
And jobless claims, what's happening on those sort of stats? Is that also picking up?
It's picking up across different sectors. So we have different levels of education, and you can see that pretty much across all of them, jobless claims are starting to pick up. But you're getting hits and misses in that market as well. So sometimes it disappoints, sometimes it surprises in the upside, and it's quite hard to call. So it's a tough picture, to Bastian's point, at the moment.
And do you think in the data that you guys are following, AI is starting to make an impact on some of these jobs? Because if you look at the tech companies, they seem to be doing a lot of firing at the moment, and they're at the forefront of this productivity wave of AI. Anyone can comment here. Are you seeing it, or you think we're still miles away from that?
We're certainly seeing it. It's a shift, but it's not all bad, right? So there's people losing jobs because of AI, but there's also people gaining jobs because of AI, and we don't see that there's a net positive or negatively necessarily. I mean, tech companies for sure, but those, we must also keep in mind that those are the fastest moving companies. So a worker at a tech company, unfortunately, is faster redundant than maybe at a manufacturing company because the job spec changes much quicker. We like to focus on the positives here. There is massive gains of productivity through these AI trends, and we think that's not going to go away and it's going to stay. And that enables us to, and leads into our inflation view also, to actually have potentially eventually higher growth with less inflation. So the whole AI tech trend, even if we can link it to some degree to people losing jobs at some point, we do think it's a positive thing for economic growth, for inflation coming down, and with that, it's a good thing.
Just to add on that, we've seen throughout history, technology has always led to jobs being reduced in certain aspects, but the other side of it is that jobs are created. So as much as these tech companies are scaling down their employees through AI, there'll be more companies out there using AI that could increase jobs.
Okay, so I like the kind of positive spin on things. Let's go even more positive soon. Back to income provider, which has lots of tools in the toolbox. And maybe tell us more about, the kind of things we've been discussing, the trends you're seeing and how that impacts income provider.
Yeah, great question. Again, I think there's two things. There's the tools that we use to get to our return target, but then there's also the tools we use to make sure we get there in the right manner, right? So that speaks to the risk and how we think about that risk. So if I look across the yield curve, so very front end elevated. So we like sort of money market fixed rates up to 1 year. Just real yields there, very, very attractive. There's obviously no credit component in that, so it's nice and liquid. So it's, if you look at the very front end, we like the fixed rates up to 1 year. Then we extend that out to say about the 5 year point. There we see some inversion in the South African curve, so very little compensation for fixed rate risk. Then you want to think about floating. Unfortunately, as Conway said, I mean, we've seen spreads compress in that space. We want to focus on higher quality names there, in line with our view. So banks specifically, some structured ideas around taking government bonds, coupon stripping them, making them floating, etc. So higher quality floating exposure in that part of the yield curve. And then we still like SA bonds. So do not steal from yourselves. So bullishness, we do see a total return, the total return expectations South African bonds out past the 5-year point being still very, very attractive. So when we're taking on some risk in income providers, so we've got about 1.5 years of duration, we want to think about sort of 10-year plus type bonds, not ultra back end, sort of that 2032 to 2037 area of the yield curve. We like that a lot. And if we put all of that together, we find a very nice diversified portfolio across the curve with some duration risk, and what we have seen, if we want to optimize a portfolio in that space with our risk hat, having some dollar exposure is actually risk reducing. So it doesn't bring in our return expectations, but it certainly brings in that left tail for us. So on a portfolio level, we've got 5% dollar exposure just to hedge that duration in the portfolio. So
why do you buy dollars and not euros or Swiss franc or some alternative currencies? Why is it every bond manager I speak to always looks for the dollar? Why is that?
Yeah, so we'll screen for all the different pairs. We'll also screen for German bunds as an example, or treasuries, etc. So all these types of tools, as I said, we have on the risk reducing spectrum.
Yeah.
We'll look at all of them. Currently most optimal, because our risk in the portfolio is duration, that's interest rate sensitivity. Our interest rate sensitivity is a lot closer correlated to SA or the ZAR dollar than some of the other currencies.
Okay.
You don't want to bring in that basis. You want something that's most optimal, and for that reason the dollar makes sense for us. Yeah.
And just, maybe you've already said it, but maybe I have to ask again, from a risk-adjusted perspective, which part of the curve are you finding the most attractive? So is it the 10-year? Is it because the short term are giving you such fantastic real yields, the 10-year is also giving you very good real yields, but it clearly comes with risk.
Yeah.
So if I had to look at all of those, I can only choose one. Where's the most? And Vishal's going to ask the same question, so I'm just asking it from your perspective. Which part do you find the most attractive?
We like all of them in different.
You've got to choose, Hank.
In different formats. So very front-end fixed rates.
Yeah.
1 year. You want to buy 1 year NCDs, very attractive, very liquid, and you want to fix those rates. 3 to 5 year, you want to be floating.
Okay.
So no interest rate risk, but you want to float with the market with some spread.
Yeah.
And then the back end, we like the 10 year to say 2037s, which would be 12 year area of the bond curve.
Okay, we've just heard from Hank and he had to give us a view. What are you thinking about your fixed income space, your bond portfolio? What are you doing?
Yeah, so I mean, as you know, we're a systematic investment house, and calculating expected returns comes quite easy to us. Underlying that is a model, and global and local factors feed into that. What we're seeing is that on average, around 11 to 12% expected from bonds. This is obviously quite attractive, and the area of the curve that we are looking to invest and being is around the 37 to 40 area of the curve, and that has quite attractive returns as an investor in bonds.
Yeah, when I hear fixed income returns, I often think you're talking about equities. It's quite remarkable.
So maybe if I may say, right, I mean, not a shot to our equity guys, but equities when they do, so maybe, so equities when they rally, you probably want to jump out of them when they've sort of rallied after a while, because they're probably going to crash, given the nature of them, right? The volatile nature of them. But with bonds, the main attribute of the return is the carry and the initial yield that you invest in. So if you're investing 11, 12%, you are on average going to expect that over the next period of time. So very attractive to be in bonds at this point in time.
So maybe if I can jump in for a second, and maybe we're going to kick Ramalan again. If you're just looking at what we're trying to sell in our income funds, or specifically in our credit funds, we have an optimizer that is clearly showing we should be buying equities right now. But what's on the tin is we're trying to sell a very smooth profile to our clients without the volatility that comes with equities. And while it's screening buy, again, once you add those risk measures, it's actually saying don't be purchasing it, even at the 17-20% that Ramya was just talking about. And in a similar vein, that when it comes to bonds, again, it's an amazing time to be invested in bonds, but for Income Plus funds specifically, we are selling a credit fund. And the credit fund, we can talk about whether there's liquidity or not in those actual instruments. Again, it does give you a premium, and it gives you a low volatile type offering. Again, we always have to juxtapose that with the liquidity, and then we include bonds in our offerings as well. And then you get a decent portfolio mix that actually gives you a bit of everything.
So you're basically saying it's got high Sharpe ratios because it's got nice returns with quite low vol.
Yeah, potentially yes, but without including those two at its max, because you want to balance the portfolio with everything.
And what do you say to people who talk about vol washing when it comes to assets that don't price too often? What do you say about that? Because there's quite a lot of feedback in the market on that today, and credit seems to me a lovely area where things don't get priced.
I would say live the Prescient way, where we have hard diversity rules. It's much easier selling a 25 or 50 million rand transit exposure than a 500 million transit exposure. And I've lived that for the last 20 years.
Okay, so diversification's your friend.
It is our friend.
The only free lunch, right?
It's the only free lunch in investing, but also you don't want to go on the path of diversification, right? Diversification for the sake of diversification. So we've proven that a 4% rule actually is not a thumb suck. It comes from backtesting, considering whether an instrument or an issuer contributes appropriately at a specific level. And you don't want to have 1,000 instruments in your portfolio. Yes, it'll give you...
It's a lot of work.
It's a lot of work. So again, a 6 billion rand portfolio with a 4% rule, you can understand that you can actually play in the market, participate actively when it comes to auctions, but then also contribute from a diversification point of view.
Okay, but let's specifically talk about your fund for a second, because one of the things we talked about, you and I, a few minutes ago was too much liquidity chasing too few goods, ultimately. And you talked about origination.
Yep.
There's another buzzword that seems to be coming in the moment on transformation around the SOEs.
Yes.
Please explain in layman's terms what that means.
So there's been a massive reform agenda pushed by government. So what we want to be able to see is SOEs, municipalities, or even corporates that have better diversification of revenue, better governance, and the ability to attract capital without state support. Let's go back to the Transnet example. Transnet has done really well being able to issue unguaranteed notes. But again, it was supported by a massive 23 billion rand guarantee in 2023, 50 billion rand, and now a potential further guarantees being asked for. So again, government support is there, but we have a fiscal issue. 77% of debt to GDP type ratios. Government can't bail everyone out all the time. So the reform agenda is there to set a platform for all of these initiatives to allow SOEs to potentially even come back to the market. Again, we spoke about right up front where there isn't this issuance. And one of the key reasons for there being very lack of issuance is SOEs and municipalities are actually missing from the market. So set the reform agenda, allow investors to get confidence in the actual SOEs, municipalities, and in the broader market again, and not just think of this spread compression train and nobody wants to be investing in credit anymore. Again, open it up, liberalize it, whether it is all the way from logistics to Eskom and no longer being the monopoly that it was. All of the reform agendas, including the more recent issues, for example, as the national state company, and how it's going to impact and how it's going to just interact with the PFMA. So all of that, we hope, will push issuance, and then our income funds and our various funds can then participate in a broader market again.
And it should be good for SA growth if we get private companies supporting public companies.
Yep.
Rupert, we've talked about income funds, bond funds, we're talking about credit funds, we're going to get to equity. What do you think of where does multi-asset sit in all of this, and how are you deciding where you're underweights or overweights and competing capital?
Yeah, so we sit right in the middle, and I think just to reiterate the systematic process, we have asset class models on every single asset class that we run in the portfolios. And where are we positioned right now? Okay, so going back to the start of this conversation, the income and fixed income side in general, with a bit more duration, you're getting very attractive yields in excess of inflation right now. So if we call that the bedrock of portfolios, and you're getting, assuming inflation sits at 3%, and you're getting, say, 11% in SA government bonds around the midpoint in the curve, that's incredibly attractive for a balanced fund which is targeting CPI plus 6. And the fantastic thing around that is that you get this tailwind. And if you go back a couple of years, that tailwind was more of a headwind. So when we talk about the last year, the performance of equity markets, the performance of fixed income markets, been a very, very strong year. But we think that there's a lot more on the horizon, in particular within the fixed income markets. If you just take the carry return, if you just say we're going to carry on from here, you got very, very high yields right now. That's not to say we don't carry equities, it's just all about certainty. So if we look towards the fixed income side, if you can make 11% with a high degree of certainty, or at the very front end of the curve, you can make, let's say, 8.5 to 9% with a high degree of certainty, versus if you can make exactly the same return with a much higher degree of uncertainty, the one you want to go for as a logical investor is the one with higher certainty. Again, that said, though, it doesn't mean that that certainty doesn't go, uncertainty at least, doesn't go in both directions. So what we don't want to do within our balanced fund is to miss out on a strong equity market rally, which could happen. We think the odds are more in favor of a headwind towards equities at the moment, so we have reduced our equity exposures within the fund.
When you use the word equities, are you talking about SA equities, offshore
Yeah, good
equities?
question.
We're talking, which equities are you talking about? Because they're not the same thing.
They are definitely not the same thing, but in this scenario, we've decreased our exposure to pretty much every equity market around the world. That's saying we're not a flexible fund. So when we decrease exposures, we're taking a 2.5% less exposure to SA equities, for example. So we want to stick to the knitting. The long-term strategic asset allocation of a balanced fund is what's the most important, what explains the majority of returns. But we're trying to pick up shorter-term certainty, let's call it that, from asset classes which look more attractive in the shorter run than the longer run.
Okay, equities, your turn. You're going to be grilled now. It's very hard to produce alpha in an equity portfolio. Yeah. Tell me how you guys are getting around that issue, or how you're mitigating that issue.
Before I go there, it's hard to get grilled when you have a systematic process.
I love it. Great answer.
It's very easy to explain what happened and where they happened, why they happened, and it's there's no one person that's waking up in the morning and saying, I want to buy Naspers here. So the Prescient equity funds run a portable alpha strategy, and the key thing about portable alpha and the way we run it is that it embodies the Prescient investment philosophy, which is rules-based, rational, data-driven, which leads to unbiased decisions and clear strategies and processes. And ultimately what we're all trying to do here is deliver consistent long-term outperformance. And whatever increment that is, that's what we're trying to do. And the portable alpha strategy is a very risk-cognizant strategy. We understand that 80% of equity managers across the geographies tend to underperform their benchmarks over the long term. And what we're trying to do is when investors make an allocation decision to equities, when Rupert or Conway put equities in their fund, we want to give them the highest probability of getting the equity market return. You can't say to an investor that invests in the equity market did 17% and our fund does 12%. Well, we strongly believe that's not correct. But on the other side of that active management, there's passive management that is set up to underperform benchmarks because of fees.
It's guaranteed to underperform.
Yes, guaranteed to underperform. It's a lazy way to allocate capital. So the portable alpha strategy takes both we want to ensure clients get the equity market returns, but also put the capital to use. And how we do that is that we split the portfolios into two separate components. One is the beta component, which is a broad market index, depending on whatever the client's appetite. It could be the MSCI World or the South African JSE index. And that will give you the exact same exposures of whatever that market indice represents. But the other side of the portfolio, where a lot of our risk cognizance via tracking errors and expected shortfalls are generated, is in the cash and income space, because we believe that in that space it is a much more reliable source of alpha, more consistent. As Rupert mentioned and Vishal, you have an expected yield of 12%. You can roughly expect getting that, and it accrues more safely. So we find that in the cash space or the income space, it is much easier to beat your hurdle rates. And in that space, we have two levers. We have the duration lever with term assets, and we have through floating rate assets, we have credit risk. And the portfolios at any given point in time are best positioned in the current environment because it has current information as well as historical information through COVID, GFC, the Euro debt crisis. And basically what the Prescient equity funds is selling is that we are selling the certainty of equity market returns while a best view on generating consistent long-term alpha. We saw it over the last year. Bond markets did 20%. It was a key driver of the portfolios. The portfolios have between 20 to 30% bonds, but just with that 20% return, it gave us quite strong alpha. But the rest of the portfolio has floating rate assets which have a spread that's above the reference rate, which is 3-month JIBOR of, call it, between 180 and 200 basis points, and that has also helped the portfolio. So even if the bond market was negative, that credit assets return would have neutralized it. And our view on this going forward is that we are always best positioned to take advantage of the alpha opportunities in the cash and income space.
Because basically you're not picking stocks, you're using the fixed income toolbox
Yeah.
to enhance your equity returns. Would
So-
that be a true statement?
Yes. So we are
Okay.
not stock pickers, nor are we passive allocators.
Okay, but Rupert, can I just bring you back in here? You run multi-asset funds. Now, it's absolutely true that Romelin can give you that alpha plus opportunity set, but you still have to choose the MSCI World versus JSC.
Yeah.
Is that something you guys do, or do you...
Most definitely. But
Okay.
just to take a step back there, so if you think about the two components of the equity funds across the world that we run,
Yes.
beta and alpha,
Yes.
right? The one thing that we know that we get is beta. And that's a key for me because I know that I'm going to get the MSCI World. I know that I'm going to get the All Share Index. I know that I'm going to get the MSCI Emerging Markets. So when I'm modeling portfolios, when I'm building multi-asset portfolios, which are largely longer term orientated, so CPI linked returns, I can model those with a high degree of certainty. Versus if I was to have a portfolio or a portfolio run by the equity team, which has, let's say, 10, 15, 20 stocks, which change in nature through the cycle. So they could have a high bias towards resource stocks right now, and then in 10 years' time, they could have consumer discretionary stocks. I wouldn't know. You can't foresee that. But what I can tell with these types of building blocks is that we're going to get MSCI World Beta. We're going to get JSC.
You get what it says on the tin.
Exactly, yeah.
Okay. We're running out of time, guys, because this conversation is really good. Just quickly, Henk, we haven't really talked about global yields a lot. You don't only ride local portfolios, you have offshore portfolios. Is there an opportunity there in the next 12 months? What are you thinking?
Yeah, absolutely. So we started with global yields when Basti
Yes.
painted the Fed picture for us. And the short and long of it is that global yields still remain elevated, more so than probably what we would have expected, say September last year. And that gives us an opportunity, right, to earn CPI plus yields in the dollar space. So specifically thinking about our very front-end global income fund, the global income provider fund, getting yields of 5.5% to 6% in dollars.
Is that what you're currently getting,
Yeah.
5.5 to 6?
Which, I mean, if you think back 5, 6,
unbelievable.
we were thinking sort of 0, 1, 2, 3 numbers, right? So
Or even negative. Yes.
So that opportunity still exists. We very much think it's a great opportunity. You don't have to take on that much risk. If we think about, Vishal made a comment around the shape of the dollar, the global yield curve, the dollar yield curve. We like the front end again. So floating rate assets, lower risk assets, credit spreads are tight, so focus on higher quality. And then what we are finding is quite a lot of South African exposure via our banks having deposits offshore, et cetera, et cetera. So nice pickup there. So absolute great opportunity, good dollar yields, not a lot of risk, and certainly one we would still take advantage of.
Risks. We've been very effervescent about how exciting everything is. What's the risks? And nobody's today talked about the enormous debt the Americans have.
Yeah.
So what are the risks?
Yeah, I think the core risks, Henk has stated them. Or let me start rather by saying what are not the core risks. We think inflation is not a core risk, so which
Okay.
is a little bit of an outlier call given that everybody speaks tariffs and how inflationary they're going to be. We don't think that's the case because we think inflation will not react over the long term to tariffs in a negative way. We think actually almost in a positive way, that tariffs in a bad way are reducing global growth, and with that we will see a reduction in global inflation from tariffs through time. There's a once-off on a one-year basis. You can see that in a one-year inflation swap, but the 5-year inflation, for example, comes down after tariffs were introduced. So we're not worried in inflation, but that leads us exactly to that point which Henk made, like front-end rates are still elevated despite the fact that we're not too worried about inflation. And that's one of the core risks, that the Fed once again gets it wrong, runs a too tight monetary policy. I
So you're
think
with Trump here. It's time for Paul to pack his bags. Hey?
that's not the angle I'm taking, it's purely economic angle. Yeah, I think to that point, it's crystal clear for us that interest rates at the front end of the US curve are actually too high and that the Fed will react, and you're bringing in Trump, and I think it's a good point to make, because the risk here is that the Fed eventually does get a little bit political, and now because of that they actually don't want to do what Trump wants and they don't want to cut rates, and that's a key risk to markets. So rates should come down. If they stay too high for too long, it will kill off global growth. We see all the cracks we described earlier. That's probably the number one risk, that the Fed gets it wrong and reacts too late. Another important risk is, and I think Conway and Rupert have spoken about these quite extensively, the one is just that asset classes which are expensive just revalue for just the obvious reason that valuation metrics through time eventually mean revert. Rupert cited equities being expensive, so not a lot has to go wrong for US equities to come down quite a bit just because they're so expensive. And Conway spoke about the tight credit spreads, I think, which is right as well. Just for spreads to go up a little bit, that could have quite an impact on credit as an asset class, negative impact, obviously. And it wouldn't be unjustified because they are too tight, right? So it's two things: the Fed getting it wrong, too tight monetary policy, maybe a political spin to that in a bad way. And then on the other side, obviously, always look at asset classes first, which are already overpriced. There's a lot of value in a lot of fixed income assets, but not in every fixed income assets. So there's overpricing as well, and that's where you have to be particularly cautious.
Okay, so what I'm hearing from that is you still need someone to run your money because it's not that easy. Back to your point, Henk. Okay, Bastian, you get to have the floor again. Can you please summarize the views from the team today and give us the insights that you've picked up and things you want to share?
Thank you. Yeah, I think the core theme, which is probably a common theme, is that we all follow a quite systematic process, which is a core strength. I checked it just this morning. We've got 22, call it unit trusts, core strategies, which we run through this volatile period of the last, call it 3 to 5 years. And out of the 22, we've literally got 18, which are on a year-to-date, on a 1 year and a 3 year basis in the very first quartile. If we look at these categories, which is a good result. I don't want to use the opportunity to brag about performance. I just do want to say that it speaks testament that our process is consistent across asset classes. So that's just the one key thing. Rupert, with the balance fund, being the main beneficiary of that. But then, yeah, just to summarize, I mean, Vishal spoke about the bond curve a lot and how much value there still is, and I think that applies, so we're quite positive on bonds. Don't expect too much of yield compression, but if we just stay where we're at, we're earning 12%, including the current yield and the roll down, so that's super attractive. Romalan spoke a lot about equities, and we're cautious from a beta point of view because the asset classes, even in SA, we don't see them as that cheap anymore. But we've got the right alpha engines, and that's thanks to Henk and the income team mostly, where we are basically running income provider, particularly successful at this time of the year, where we have got so high real yields at the front end. Rupert spoke about balance, where it's all coming together, and then Conway on the credit side. I guess it's a true edge to have this ability to originate assets and to diversify your credit fund broader than just looking at these overpriced assets where spreads are too tight. So it's all coming together in a nice way, yeah, I think we highlighted some asset classes which are attractive, highlighted some which we see as less attractive, but the true strengths, I guess, of this approach comes through in a systematic fashion, a team approach, and that's, I think, why we see those consistent results which we're seeing.
Fabulous. Does anybody want to add anything? Thank you very much for listening, everyone. I've learned a lot today. I hope you have too, and please don't forget that it's live Q&A now, so please send your questions. There's a box at the bottom. Send them through. Thank you.
Hi, everybody. Thank you for joining us. Thank you for sending the questions through. So we'll go through them, as many of them as we can. I think the first one here is for Henk. What mechanisms does the Prescient Income Provider Fund employ to protect capital and maintain its goal of no capital loss over rolling 3-month periods during market crashes?
Awesome. Thanks, Romeo, and thanks everyone for listening today. Great question. Great one to start with. It's certainly what we see as setting ourselves apart in the income space is our ability to manage risk in the income provider fund. And the mechanism we use, or the tool we can call it, is our risk budget approach, right? So what we do very successfully is to understand how much risk we can take in the income fund. So if you assume our target is to not lose money over a 3-month period, that would mean the next 3 months of return is our budget. So we work that out to be the yield for the next 3 months, or a combination of what has happened 2 months and 1 month ago, plus what we expect to return, right? Because it's rolling 3 months. So that's the budget component, the easier bit to understand. Then the tricky bit comes in into trying to understand how much risk we are taking in the fund as we speak, right? So the current risk of the current positioning of the portfolio.
And there we've done a lot of work over many, many years to understand exactly how much risk each instrument and risk proxy or asset that we introduce brings to the portfolio on a 3-monthly basis. And to be able to do that, we have the data going back 30 years plus to show us what the total return profile of each asset would have been over a 3-month basis. And with that, armed with that knowledge, we can then group our portfolio into the different risk buckets, run the current portfolio to see the profile of returns over 3 months for that fund, and then map and see how that relates to how much risk we can take. So have a budget number and see how much risk we are taking, both on a 3-monthly basis and at all times make sure those two speak to each other. So that's the mechanism. Some of the tools we can use to reduce the risk in the portfolio. So we think about different assets that in periods past have been risk reducing, things like US Treasuries, German bonds, etc., etc. In the current environment where duration is quite a key component of the portfolio, and specifically South African interest rate risk, a key risk reducing asset we have in the fund is the exposure to US dollars, right? So we have a 5% exposure to US dollars in the portfolio via derivative. And that's really, really helped us nicely throughout the first 6 months of this year, specifically thinking back to Liberation Day, volatility around the tariffs, etc., where we saw yield spike, but also rand weakness. And that hedge asset that we have, the tool or mechanism we use to manage our risk, really came through strongly there and gave us a profile of return that we think is appropriate. So that's the risk budget mechanism and some of the tools we think about when it comes to managing the risk on the portfolio.
Thank you, Henk. The second question we have here is, with CPI printing at 3% last week, will the SARB cut rates at this week's NPC meeting? Vishal, I think that's a question for you.
Indeed. Thanks again for listening. So indeed, core CPI came out at 3% last week. However, having said that, I mean, the SARB does not use one particular number to inform their view on how they're going to cut rates. They will take it into consideration and look at the general trend of CPI. So indeed, yes, it came low at 3%, but they take into consideration in their QPM model. Now, having said that, it does give a good playground for them to now decide to go and cut rates. We think they obviously are quite restrictive where they are right now, so they can indeed cut rates where they are, but we do not think that necessarily will be the case. At the back of their mind, there's a lot of external factors, with tariffs, and also around the new inflation target around 3%. So now, if they decide to, obviously I haven't discussed it, but that target down of around 3%. So now if they decide to cut rates and then inflation prints out at, let's say, 3.5%, I'll make an extreme case, then they'll be very wary and sort of feel that they should have maybe kept the band higher for a bit longer. But so that's in the back of their mind. So yes, at the CPI at MPC on Thursday, it'll be a really tight decision whether they will cut. We think that they should be cutting and about 25 bips, but yeah, we will wait and see for Thursday what they will do.
Next question we have is regarding equities. So equity markets have rallied, valuations look stretched, and sentiment is not overly bullish. As an index cognizant manager, how do you respond? Yes, I'll take that question. I think throughout the earlier discussion, there has been a few stabs at the equity funds. I think the first thing we think about, and we need to stress that, is the equity investors' time horizon is far longer than 1 year. It's 5 years plus. And when you look at equities, you can have both a short-term and a long-term view. And that's split into a strategic allocation and a tactical allocation. Even though valuations seem unattractive right now, from a tactical point of view, you can be underweight. But every allocator knows that if you don't have equities in your portfolio, you're likely to miss out over the long term. And the equity asset class has provided allocators with long-term outperformance and diversification benefits. We've seen earnings season start in the US, and previously markets were supported by strong corporate earnings. There's a very small amount of companies that have reported so far, so there is possibility for corporate earnings to boost markets even further. I think in the Prescient equity funds, our focus is on giving our clients and allocators within the company the certainty, as Rupert mentioned, that he is going to get the market returns. And in addition to that, we aim to give the clients a return that's slightly above the market. and over the long term, you'll see that outperformance will come through. And we trust our multi-asset team to make the best tactical and strategic allocations at every given point in time. I think we have time for one more question. And we see the income provider fund as well as the global income provider fund available in AM ETF format. Please could you talk to us about this and how investors can access it?
Yeah, great question again. So both those portfolios are now available to buy on the JSE, which is for us awesome to see. Prescient's got as a group the platform to host these actively managed ETFs, and we wanted to give a wider range of investors access to both the income provider fund and global income provider fund, as we see it as quite a key tool in portfolios or personal share portfolios. So you can go onto the JSE, you can look for PIP ETF, you'll find the local income provider ETF, and you can buy it as you buy any other shares. It's important to understand that that's a feeder, so you buy the ETF, that money goes straight into the unit trust. So there's no difference between an investor buying the ETF and an investor going into the retail share fee class of the unit trust. So we've monitored it over time, so it's been running over a year. Grown nicely, so about 600 million now in the ETF itself, and really doing what we want to do it. Just creating that steady alpha on top of what you can expect from core rates. So nice avenue for us, a nice way to capture quite a client group, as well as an easier way for some investors to gain access to our portfolios.
That's all we have time for today. Thanks everybody for joining. Bye-bye.